If at any point in time, for any reason, no questions asked, you say, I'm dissatisfied with my service, you immediately refund the last month. And what do you need us to do to transition you to another firm? We have a commitment to excellence, so we're gonna invest in quality. That means we're not gonna skimp in anything. Like every single thing we buy, the software package, the brand of our pens, the brand of our paper, communication software, our phone system, it's going to be top notch, right? Because we are committed to excellence. And the idea is that we can always exceed the standards that our clients expect. And as part of excellence is a satisfaction guarantee. When you tell your clients, listen, you're going to pay X amount. Now we're doing satisfaction guarantee. If at any point in time, for any reason, no questions asked, you say, I'm dissatisfied with my service, you immediately refund the last month.
Okay, hi everybody. Welcome to Beyond the Books, your home for all things accounting and accounting firm growth. Super happy and delighted to welcome Hector Garcia. Hi Hector. I think probably most of this audience knows Hector. If you don't, obviously he's well-known CPA, QuickBooks advisor. He's built a huge following, nearly almost 300,000 followers on YouTube, I think, at this stage. And he's creating sort of daily or weekly easy to follow videos that are going to help business owners, accountants on all things QuickBooks, all things mastering sort of the financial workflows, everything from very specific tools all the way up to large sort of bigger picture how to grow. And one of the topics that we're talking about today is actually how to price, which is a key sort of aspect to your growth. And I'll allow you, Hector, to maybe do a quick introduction and share your slides. But today we're going to be talking about sort of everything around increasing prices. So coming into this year, how do we make sure we charge for our services, which is I think a historically difficult or a problem a lot of folks in this world don't tackle well enough.
Alrighty, so welcome everybody to Increasing Prices with Confidence. You're actually going to get a sneak peek of some of the content that my brother and I are preparing for our upcoming Reframe conference called Pricing with Confidence in Miami in November. So you're going to get sneak peek. You're the first group of people that actually sees this stuff that we've been working on. So I'll talk about today about myself really quick. And then we'll jump right into what triggers a price increase. We're going to talk some common situations that will cause a firm or an individual accounting professional to say, you know what, I think I got to increase my prices. We'll talk about the profitable firm business model. We're just going to generally talk about how to sort of backwards engineer the profits that your firm wants to make to the price that you need to charge in order to achieve that profit, right? Because a lot of times we don't think about that. Profit is sort of the afterthought, but if you lead with the profit calculation, then you'll know how much you need to charge for your services. Then we'll talk about communicating the price increase, because that's always a sort of weird and awkward conversation. So we're gonna break it down into a framework that should make it easier to digest or to follow. And then we'll talk a little bit about getting prepared for your client reactions. That's what we fear the most, is how they're going to react to this. And then if we have time, we'll briefly talk about the conference that's themed around this topic and how we are going to bring this information in the theory and the practice to 150 forward-looking accounting professionals in Miami this coming November. So by myself, Justin already kind of covered it. I have a YouTube channel. I've been using QuickBooks since 1996. When I was a very young boy, I was like, maybe I was a teenager, 15 years old. My dad came to me and says, here, go and do all this data entry in QuickBooks. And I didn't know what I was doing. I just did it. So I have a long-standing relationship with QuickBooks, but I didn't really become independent, leave all my jobs that I've had, my regular full-time jobs, to become a firm owner until 2008. So I've been formally practicing as an accounting professional for about 16 years. I also, so as I mentioned, I have a community and a conference called Reframe. And I'm also the co-founder of a software company called WriteTool, which is a Chrome extension that works for QuickBooks Online. If you have access to the slides, you can click on all those links if you want more information. Now, I have a personal mission, and my personal mission is to, quote, save the accounting profession. Now, the accounting profession might be saying, Hector, we don't need saving. Okay, well, fine. Okay, maybe not. However, the introduction of artificial intelligence in the retail version, ChatGPT, a couple of years ago, on top of what's been happening in the backdrop, like software companies encroaching in a territory and offering services that we offer, and these are the same software companies that we have. We've been there, we pay patronage or whatever. We've been buying their software for a very long time and partnering with are the ones that are doing it to us, which is actually kind of insane. And then we have in the backdrop, we also have globalization and outsourcing overseas, and we have tons of young potential accounting professionals leaving the profession early or not even looking at it because they're attracted to Silicon Valley and the tech world. So the accounting profession maybe doesn't need saving, but it's almost trending like it might not be relevant in 10 or 15 years unless we do something drastically. So the way I think the accounting profession might need to be saved is by rebranding it. Since we can't change P&Ls and balance sheets, debits and credits. Actually, I think accounting is a perfect science. I wouldn't dare to touch the science and methodology of the work that we do. And also, the vast majority of accountants are just incredible people. So like those two things don't need to be changed. What needs to be changed is the perspective. So I think we got to rebrand the profession so it's sought after as the opposite of what it is now. Creative, innovative, and forward-looking. That's completely the opposite, right? You think of an accountant, you think of a person that's very square, not creative, a person that doesn't want change, right? Not innovative, and a person that's a really good historian, as a financial historian, because that's what we do. We tell financial stories about the past. That's what financial statements are. That's what a financial audit is to tell the story or corroborate a story of what happened in a business through the numbers. So that's not forward-looking. That's backwards looking. So I'm trying to flip it on its head and have a really big audacious goal, which is this is how we're going to completely save the profession is by rebranding us for people to see us as the opposite of what they're used to seeing us. Just
Hector,
add something to that?
Yeah, what do you think? So pricing being one of the means by which you maybe buy yourself. Do you think about pricing as sort of a necessary tool to buy yourself the time to approach these customers less transactionally and more, more creatively, I guess, as you think about it?
Sure. So I think if people were to ask me, Hector, how is pricing or thinking about pricing for our professional services change this, or how can we even save the profession through pricing?
Yeah.
And I actually think that pricing tends to fix a lot of problems. So just in general. For example, how did Disney World solve the overcrowding of the parks? Which, by the way, I'm pretty sure you would argue that it is already overcrowded, but it could be worse, much worse. Trust me, because I've been going to Disney for 15 years.
Okay.
It is through pricing, right? So it is by increasing the price, less people show up. The other piece is the long lines. So how do you solve the long lines? Is by creating a separate product where people get to skip the line or pre-plan, fast-track the lines, and then there's a separate ticket price for that. Because what ended up happening was Disney introduced the Fast Pass. Everybody was using the Fast Pass, and then all of a sudden it wasn't fast anymore. So you have to create tiers to segment the customers based on their pain threshold or patience level for certain aspects of your work. There are some of clients that we have want the work yesterday. Some clients that we have can go on extension and can wait until October. If you charge those two clients the same, that's a huge problem for your firm, because you're not creating tiers or categories based on how the clients reward you or punish you based on their level of commitment, their procrastination, their urgency. Pricing is a very important tool to, I don't want to say manipulate, but to shape, right, how you want these customers' relationships to work out, right? For example, you can have a client call you and say, hey, I need to do my return before April 15th, okay? And it's April 10th. And you can say, Mr. Customer, it's only 5 days from now. I want to put you on extension, right? And then the customer will go, nope, it needs to be April 15th, period, okay? Then you can say something like, you know what? Thank you, Mr. Customer, for completely upending my entire practice and making me change and shift resources just because you want it done in 5 days, right? So what you can do is you can say, I can put it on rush for you. There's a 50% increase to the price. So instead of being 1,000, it's 1,500, and I guarantee that I'll have it done by April 15th. If that customer is $500 worth or whatever level urgent, right, then they'll say yes. If the level of urgency was just them being vehement, right? Just them having an idea in their head that they don't want to go away, and then they go, you know what? I could wait. I could wait. So I think that throwing a price tag into something that you don't want to do or you want to do differently tends to shape the behavior. And if they say yes immediately, like without even thinking, $500, of course I'll do it, then you're probably underpriced that rush fee anyway. Like anytime you do something like that, it needs to hurt a little bit. Like it needs to be high enough that it hurts a little bit, but not high enough that the customer, or not low enough that the customer just says, yes, absolutely, that's a no-brainer. So in order
right. So it almost needs to create that discomfort. Like any almost with everything, learning comes through discomfort, and that probably includes every conversation that you have with your customer about pricing, right? It's just like, this is supposed to feel uncomfortable, because if it doesn't feel uncomfortable, it's probably too easy, and you're probably not pushing things. What do you think if you were to randomly sample the accounting world, how far below what you think they should be charging do you think an average accounting firm is placing their prices?
I could only, so if your question is in general, right?
Yeah.
Across the board in America, Canada, whatever.
Yeah.
Are accounting firms charging at the right level or below
Yeah.
what the level should be or above what the level should be? I think anecdotally and with some of the experience that I have, I think that most of the times a brand new client gets priced correctly. A client that's been with you for 5 years or so is priced way incorrectly. And let me explain my logic on this.
Okay.
There really isn't a right way to price a brand new client correctly, because you don't know what that relationship is going to look like. You get an idea through the conversation, you have an engagement letter, you set expectations, you have a list of what you will do, what you won't do. If you're very avid, you create three packages, and then the packages let the customer choose how they want to interact with you. If you are a firm that charges by the hour, maybe you're not so concerned, generally speaking, whether the work gets bigger or smaller, because the client already sort of agreed to paying based on effort. Now, my friend Ron Baker would say that charging by the hour is a terrible customer experience, and if you're an accounting professional, you know that you send a surprise bill to someone for 17 hours, and the customer's almost always going to say, why did it take you so long, or that shouldn't have taken so long. And those are really like sort of useless conversations, because whatever the customer's perception is of how long accounting work should take versus how long it actually took, it actually doesn't matter. It doesn't matter who's right or who's wrong.
Right.
What matters is that the entire conversation is a huge waste of time. So I would say in general, I wouldn't put a number to whether or not accountants generally are underpricing or overpricing new clients. What I can tell you is that the average 5-year client is underpriced by 50% at least.
Wow. Okay.
The reason for that is because actually there's a couple of reasons to that, and I want to.
Yeah, I don't want to overrun the slides. And Matt, who's got a question,
I'm okay
we'll get to your question.
I'm okay with at least finishing this specific point here, which is the reason why a 5-year-old client is almost always underpriced is because the accountant actually gets better over the work and the accountant gets better and more efficient over the 5 years because we're learning more from how the client works, and we're learning their quirks, and we're learning their systems, and they're learning the systems and our quirks. Like all these things are sort of happening at the same time. So the work is getting easier. Generally, the work is getting easier. Okay, so in the back of our minds, as accounting professionals, the work is getting easier, which is kind of a good thing. Let's call that a good path to profitability. But also, random things come along that weren't planned at the very beginning that throw sort of curves at the situation. The customer may grow or shrink. Their complexity may increase or decrease. But bottom line, and tend to compensate, right, all these unknown things that we didn't know with the fact that the work is sort of kind of progressively getting better. And also we got comfortable with that income coming in, and we can't fathom losing that income coming in.
Right.
So all these factors are coming into play that make it very challenging for us to want to increase the price for our clients. So we tend to send an email and make it, quote, reasonable, 5%, 10% inflation adjustment, and we hide behind, hey, costs are going up, therefore our prices are going up, instead of having a real conversation about scope creep, what's included, what's not included, growth of the business, complexity, that sort of stuff.
Yeah. Okay.
So, and then Matt has a question that says, how can I effectively communicate a price increase without losing long-term clients? So Matt, I'm going to give you a short answer and a long answer. The short answer is, you have to walk into a price increase conversation totally comfortable with losing the client, period. Okay? If you are not prepared to lose the client, you will be played with by that client. Like, you will have that conversation, you will take it back, you will apologize, you will contort yourself, and there's a possibility that pricing conversation would go so horrible that you'll end up committing to doing more work for the same amount of price because the whole thing went array. So
right, or just erode the trust, just sort of erode the relationship with the client and end up with no upside because they just think you're trying to, I don't know, potentially they view it as maybe a cash grab versus a systematic approach to how you're approaching pricing, and you haven't framed your value yet. It's just you do all of the worst parts of the pricing increase with none of the upside of it.
Right. And the erosion, the potential erosion of the relationship sometimes could be temporary. So there's a temporary hiccup, let's call it that. But then because of a temporary hiccup, we renew that relationship with that hiccup of that weirdly gone pricing conversation. And then we end up having to make up for it. And that's what I meant by end up doing more work. Okay. So let's talk about what triggers a price increase with a current client. And we're going to split this into 4 categories. So I think there's essentially 4 categories where circumstances cause you to have a price increase. One is the work, the other one is the firm, the other one is the client, and the 4th one is the strategy. With the work, and none of this stuff is personal, which is this is the reason why I put them into these groups, because none of this is the owner wanting to make more money. And that's a really important piece of it, that the owner wanting to make more money, it's should never be the trigger for a price increase. It needs to be couched, communicated, explained, lived, and said, and believed as being one of these 4: the work, the firm, the client, or the strategy. So the work, what is the work? So the work would be increasing workload, volume, complexity, right? Client growth. That's a very, very common one. The second one is often out of scope requests. Now, I personally don't think out of scope requests are a bad thing. I think most accounting professionals are sort of stuck that out of scope request is a bad thing. An out of scope request is a client inviting you to play a bigger role in their lives. Okay, that's how I reframe an out of scope request, right? So hey, I don't understand my health insurance. Can you help me review these documents? That's not something accountants do, but that might be something an accountant that has experience reviewing their own health insurance for their firm could do. Now, is that part of the work that you've got contracted for? No. Therefore, we see that as a negative thing because we think that the customer asking for that work is the customer demanding you do that work. And
Right,
those two
right.
things are two different things, right? The customer demanding you do this because it should have been implied that that's included is different than the client inviting you to play a bigger role in their financial lives. So if you see often out of scope requests, that is a possible trigger for a price increase, because you can say, Mr. Customer, in the last year you've had all these the out of scope requests. I think we would love to help you with that. We would love to help you with that. But therefore, we're going to build a package that includes us building the capacity for that, right? It's not charging you more money because you're making us do more work. It's help us plan to deliver a kick butt service called insert blank out of scope request here.
Yeah. Okay.
And the third one the third one connected to the work is non-standard process required. So this is when our customers say, you know what, we are now selling to Walmart, therefore you have to go into portal ABC and pull these documents.
Yeah,
and
yeah.
you have to go to this banking website to pull on the factoring statements, and because now we have to factor the stuff. So like there would be all these non-standard processes that are now required. The customer says, no, I don't want to use your portal. You got to go into my Dropbox. Okay. So every time that happens, you have to decide, okay, Mr. Customer, you don't fit into our process, or hey, the work is getting more comprehensive. It requires a non-standard process. I'm going to give you a package. I'm going to offer you a package that includes that, where you have to make the choice whether you conform to our process or we conform to yours, and there's a bigger price tag for non-standard.
And this is an ongoing sort of step increase in pricing versus like a one-off line item that is.
Yeah, this could happen at any. This could happen any point in time of the year. It could happen. This is something you could review once a month or once a quarter. Typically, a once a month review like this would be way too anal, in my opinion.
Yeah. Okay.
I think quarterly or every 6 months it's good enough. It's
okay.
Fine. Okay, so the second category is the firm. Okay, so what could be happening inside the firm that triggers a price increase, the requirement of a price increase? One is the standard of the past 5 years, right? Inflation, increasing costs. Some of these software companies are getting really bold on their pricing, and what we used to pay, $500 for every 3 years. Now we're paying, $10,000 a year or something like that, because they completely changed their model from desktop to cloud or whatever, right? And it's across the board with not just, the stuff I'm involved with, like QuickBooks and stuff. It's just across the board. Software companies are just getting better at pricing themselves too. So that's costing us more. And then we have to make investments into new software, new training, new infrastructure, not just for our employees to be relevant and efficient and with the times, but also to be able to serve our clients. I am going to make the assumption that in the next 3 years, our clients are just like our clients assume that we can help them with their QuickBooks because we use QuickBooks. They're going to assume that we can help them with their AI because we're supposed to be using AI.
Right.
So where is all this investment into the AI tools and learning the AI tools going to come from? And it's going to come from a firm's decision to make an investment, right? And then that probably will trigger a price increase.
Yeah.
The third one is the client, right? The client could become more demanding. That happens, or the client could become less pleasant.
Pleasant is a nice, it's a nice way of wording it.
Right.
Hector.
Yeah, they become an a-hole or whatever, right? A pain in the butt. But the client becoming less pleasant doesn't always trigger, okay, just fire the client, right? So a client becoming less pleasant, it could be a combination of things. Sometimes people are just like, there's some people that are just like bad and you should get rid of them and all that stuff. But there's a client that becomes less pleasant because they're becoming irritated with something that they were expecting that they're not getting from you.
Right.
And most of these clients actually are not good at communicating it. They're only good at grunting it. Okay. Like, and go, hey, last year when you said this and that, my expectation was A, B, and C, and you only delivered A and B. And we didn't make any space to converse about that piece that was missing. And I feel that your firm is completely unaware that I have this sort of like customers will never have this conversation.
That would be ideal. Is there a common way to deal with somebody that you're increasingly feeling like or hearing is becoming increasingly difficult to deal with, but isn't somebody that's insulting your employees or anything that is somebody that you don't need to get rid of, but it's just becoming painful. Is there a way to sort of step back and reset that relationship?
Yeah, yeah. I mean, I would. There's two things. Obviously, telling a client that they're becoming less pleasant, I don't think that's ever going to be
No.
a positive conversation. Although that's the honest one. I think it might be useful to focus on the facts. You could say, "Hey, Mr. Customer, when we first got started, we sent you an email, and within 2 days we got a response, and we asked you to upload the documents, and you gladly did it. And when we called you, you always answer the phone, and then when you called the office, you were comfortable with waiting 2 days for a callback. In the last couple of months, I've noticed a couple of things. One, we don't get answers to our emails. The documents don't get fully uploaded. You don't answer our calls as quick as you used to, and you get irritated if we don't answer within 3 hours or 5 hours. So obviously something has changed. I would love to help you feel the same way you felt when we first got started, and I just want you to tell me, what can we do to reset the relationship? Up front like that. But the thing is that it's gotta come from you. You gotta be the one that brings that conversations, because most of the clients don't really do that.
Okay.
The last category, and then we got some questions here in the live chat, which we'll address as well. The last category here is the strategy. Okay, so like your firm could realize that there has been a value mismatch all along. Like you priced wrong in the first place. Like way under your competition. And then we can have a discussion about like the market price as well. And I think we have a live question on that particularly. But there could be a value mismatch where, hey, like the value you create is so high, especially compared to the competition, that you've been underpricing for a long time, and you just have to adjust. Period. That just needs to happen, regardless of whether the owner wants to make more money or not. Like you have to have a value. You cannot have a value mismatch. And also your positioning. Maybe as a firm, you no longer want to be positioned as a low-cost provider. Understand that every single one of us start day one with zero experience. Every single one of us at some point in our career will have 10 years of experience, and at some point 25 and 30 and 40 until we retire, right? So it is natural for you at some point in your career to deeply underprice your services, so you can get paid what you learn, right? The ultimate expression to this would be like, what's the name of when college kids go work for free in a company? I forget what the name of that is.
The co-op,
No,
the co-op term, the
not the co-op.
internship.
Internship.
Yeah.
So the ultimate expression of this is an internship, right? Like you are 25 years old, you just graduated from college, or you're about a year away from graduating from college, you know nothing, and you're willing to give away your most precious asset, which is your time, so you can learn from a company that knows what they're doing to work alongside someone with experience. So there are situations early in our career or early in our business where we almost always ended up behaving like an intern, comparing what we were getting paid versus what we're doing, because we were learning. I remember when I first got started, my very first client, I was charging $125 a month. The first month, I felt that it was great. I have no experience, and this guy's giving me $125 to basically get paid by to learn. Within 12 months, after we ended up saying yes to every single, there wasn't such a thing as a scope or out of scope request. We didn't know. After that, we got to the point that it's like, hey, if we don't charge $750 an hour, we're literally getting paid under minimum. $750 per month for this job. We literally are getting paid under minimum wage. So having a conversation with a client to go from 150 to 750, we had that conversation. Surprisingly, the person made such a strong argument of logic that the shift of pricing was so crazy that he convinced me, gaslighted me into raising it from 125 to 150, and I made the mistake to do that. And that's going to happen to us. That's part of the natural progression of things. And obviously, as we get older and wiser, we learn we learn how to protect that a little bit better. Okay.
Right.
So
Okay.
now that we covered all the triggers that have a price increase, Justin, maybe we can go to the chat and see what.
Yeah. So Deborah's got some question, and SR has a question that I think. So Deborah's sort of, I think, asking. We don't have a common starting point. Like, we don't just talk about what exactly should these firms be charging, right? So she's saying, like, why don't we just talk about actual numbers? We know that a high-priced attorney is $1,000 an hour. You know, a low-priced one is probably a couple $100. And she's saying, you know, clients just have no idea what visionary firms are charging. I wish we would discuss numbers. And Deborah, I'm not sure if you want to know specifically, you know, a starting point, but I think Hector, actually, some of the slides in a bit are going to talk about exactly how to set that baseline price based on your current operating costs. And SR, I think his questions around financial benchmarks, I think those are going to be nailed in the next couple of slides. Okay.
So let me go to Deborah first.
Okay.
Deborah, let's talk numbers right now. Deborah, I have zero context in terms of how much experience you have, your area of expertise, your branding, whether or not you give a value guarantee or satisfaction guarantee, the type of clients you worked with. You know, I got zero context. So Deborah, if I were to tell you that you should charge a minimum of $5,000 per client, what would your answer be? So maybe you go, that doesn't work for me, or the type of work that I do, or the type of clients that I work with, or the type of, or my area of expertise, or my brand, or whatever, right? So just throwing a number out there, it just is completely irrelevant. And also, one of the things I learned from Ron Baker is price the client at the job. This is not a pricing class. I will talk about pricing all year, including through my conference and Reframe in November. I'm going to talk about structure of building pricing. We're just discussing, like the purpose here is to talk about removing the awkwardness of the price increase conversation. So Deborah, we're actually going to get to some of the numbers. So if you're an accounting pro, I know that you want to see that. So we'll get to that a little bit. But the point I wanted to make is, please do not use somebody else's reference point to inform yours. Do not use somebody else's reference point to inform yours. It's as if I went to look at my friend and saw his wife, and then based on how pretty his wife is not, then I should decide how pretty my wife should be. That's just doesn't work like that. It should never work like that. Relationships are not about comparison. Relationships is what you build together. Okay, it has nothing to do on whether the person next door has a better thing or a lesser thing of the same thing that you're trying to figure out how much yours is worth. Be per client, per relationship, so price the client, not the job.
Okay, and so in a bit, in a couple slides, we keep going forward. We're going to have sort of a bit how to build that, how to look at some of your expenses, and how to build a baseline of profitability, and then how to judge where you might want to start charging. Okay.
Yeah, and I'll move a little bit faster. So the next slide called price increases to protect your firm. I won't read the whole thing, so just leave it there for people to have access to the slides. Essentially, the price increases are going to be meant to maintain financial health so you can lead by example, support your team so you can attract and retain talent, preserve service quality so you don't cut costs and corners because you're underpriced, ensure business longevity because you need to build resilience against economic pressures and unexpected challenges. Imagine if accountants were so hurt by COVID that they couldn't help their clients through navigating all the crazy government programs and loans. Imagine if accountants did not have the profitability or the resilience to withstand COVID. What would have happened to the economy, especially in America with PPP programs and the SBA programs? What would have happened in America if the accountant business model would not have been resilient enough to go through COVID? Imagine if hospitals didn't have a strong enough business model to handle the craziness of COVID. So you have to protect your firm. You got to protect your industry, because At some point in time, poop will hit the fan, and you're going to be the one helping undo that mess. And if your business is barely making any profit, you won't survive anything like COVID anymore. And lastly, you protect your firm because by increasing your prices or matching your price, you're going to have clients that are going to have a clear expectation, and you're going to filter out clients that underprice. Let's talk about the numbers, Deborah. This is the part where you're going to like quite a bit. I'm going to talk about what I think should be a profitable firm model. Before doing that, before doing anything having to do with numbers, I want you to, let me stop sharing for a second. If you're watching live or listening live, or maybe the recording afterwards or whatever, I want to ask you a question. Okay, you are an accountant, you are a business advisor. If a customer came to you and asked you, what percentage of profit should I make as a business for this to be worth my while? And I know a construction company and a software company and a restaurant should all have different numbers and different benchmarks, but think about this. You're a business advisor. Your client comes to you and goes, what percentage should my business make for it to be worth my while, for me to call it a profitable business? Justin, let me ask you that. If you were to quit your job and start a business, what percentage would you be looking for?
Yeah, I did. I did this for a bit. I think it changes as you scale a little bit, but obviously you're adding to the top line. But I think when we were really early, we're aiming for somewhere around 40% was ideal. Realistically, we were getting closer to 20, but that's because we weren't spreading a lot of costs. Eventually get to spread a bunch of those revenues across a less growing set of costs. So we were trying to grow that with an ideal of like trying to get up to 40, but we were happy at 20 to start, and 50 was like our like fully optimized North Star.
Perfect, and that kind of corroborates with my slide here, which is, you wanted 40, 20 was more realistic, so the halfway point in that is 30. Like, I think that every business should always aim to operate at a 30% profit, period. And the way every one of my clients tells me, how should I think about revenue, direct costs, admin costs, and profit? And I use this formula, and I say every business should have 33%, a third of their cost be all of your direct expenses and payroll. The other 33% is all your admin and infrastructure, and the other 33% should be profit for the business owner or for the owners. Okay, it's a simple formula. Comporting to that, I think that every firm should have 30% partner profit or owner's profit, and the breakdown of that is about 20% goes to direct payroll. This is your non-admin payroll. These are your accountant, bookkeepers, tax preparers. 10% could be indirect payroll, so office manager, customer service, salespeople. 25% infrastructure, rent, internet, hardware, and about 15% direct costs, software, supplies, and materials. You can modify these a little bit. It doesn't have to be exact, but this is kind of the model. So if you were to look at a financial statement for a firm that does $1 million, then the numbers that you actually expect is about $150,000 in direct costs, $100,000 in admin payroll, $200,000 in direct payroll, and $250,000 in infrastructure costs. Now, post-COVID, firms are changing and they're moving to a more remote model. They have less brick and mortar type of expenses. So the profit should be the same. It should be the same 30%. The only thing that shifts is you have less infrastructure costs, and you have a little bit more payroll, right? Because you'll compensate your employees a little bit more for using their own office or using their own internet or their own cell phones or whatever. And also your direct costs go up a little bit because you need more remote software and remote support and more IT people involved with the whole remote working scenarios. You look at a financial statement that looks like that. Again, the formula ends up the same at the 30%. Now, so Deborah's question was, just give me numbers. What I'm giving you is I'm going to back into the number. First, I have to convince you that you agree with me that you should make at least 30%. Like, you have to, I convince you, Justin, I got to convince everybody here, your firm needs to make 30%. Okay. So based on that, if you agree with this formula, and based on the brick and mortar firm and the remote firm, your direct payroll costs are roughly between 20. It's true, okay, that's true. 20% would be 5x, right? So 20% times 5 would be 100, and then 25% would be 4x. So essentially, price should be 4 to 5 times the cost of your direct team. Again, your price should be 4 to 5 times the cost of your direct team in order for your profit to end up at 30%. Now, we should never price based on cost. We should always price based on value. But because that is such a nebulous term, and most people go, Hector, I don't get it. I'm dizzy hearing this term over and over, and I don't know how to measure value. Customers don't know how to measure value. Customers only know hours or time or effort. But what I'm telling you is, if you back into this like this, 4 to 5 times the cost of your direct team, it actually more or less gets you closer to what a healthy firm should be running at. And then after you price based on 4 to 5 times the cost, then you have to figure out, do the evaluation, is that price commensurate to the value that we're creating, right? So it's a two-step model. First, you have to price it so you have a healthy firm. And then second, this is the branding, marketing, goodwill effort of it. Is what I'm doing valuable enough for the customer to part ways, with their money at whatever rate we're going to charge.
You're going to back into this from a behind the scenes model. You're going to then figure that out. And then when you present it to the client, obviously you're not going to present this. You're going to present the value statements around.
Correct.
You never put, you're going to present the value, but you're going to be
internal costs. You never present, you're never going to tell your client, by the way, John who's working on your account, John gets paid, $20 an hour, and because of that, I'm going to charge you $100 an hour. That conversation's never going to go right. Okay, so
this is just what you're doing behind the scenes, and you're coming at the price that you put in front of your client from both angles.
Correct.
Yeah.
Correct. So now let's talk about how to actually price a specific job. So the way I think about pricing a specific job is, I look at the job, I look at the team that is involved, and then I say, okay, if I were to grab duplicates of that job, let's say, for example, have a client that needs monthly bookkeeping, it's a $500,000 a year revenue client, it's a restaurant, whatever. If I were to grab that job, and you kind of have to do the job first for a month or two to kind of understand how much time it occupies from a team member, and I mean an average team member that's not slow or not fast, like the average team member. And I determined that, look, the maximum amount of jobs just like this that my team member can do per year at max capacity is 10. Okay, so if that's the way I measure, I back into looking at a job and saying how many of these can my team member take, then I pretty much know that it's 10%. It occupies 10% of their time. So then very easy. So I grab their team members' total costs, their payroll, their taxes, their benefits, whatever it costs to have that employee on staff, and you multiply it times the percentage of time that it occupies. As 10% of $75,000 a year is $7,500. And then because it's 4 or 5 times, I just take 7,500 times 4 and 7,500 times 5, divide that by 12, and that gives me the range I should be pricing that job at in order for me to backdoor into that 30% profit. So a $75,000 a year employee that can take 10 jobs of the particular job you're looking at 4 times their cost or 5 times their cost, you will price the job somewhere between $2,500 and $3,125.
That's great.
What does this number mean? Now, to your customer, that job could be worth $500 a month, and then you could be completely insane, right? To them, right? I'm not saying you are, but to them, you could be completely insane. And then you get to the point you go, wait a minute. I follow Hector's advice. I follow the formula. I price the job the way he tells me how to price. I have a sane profit. 30% is it's a not insane amount of profit. It's not too high, too low. It's normal. Like if you would give your customer advice to try to make 30% net, then you should follow the same. You should eat your own dog food. So you're going to follow the same advice, try to get 30% net. So if you follow the formula, but then it turns out that these $2,500 to $3,125 that you are proposing as a service fee to the client, if it turns out that that client thinks that that number is crazy, in the client's mind it's not worth more than $1,000, then there's a total disconnection what they think the service is worth versus what the service is actually worth. And then they could come back to you and go, but Hector, for $1,000 a month, I can find a bookkeeper that's $50 an hour, and it won't take them more than 20 hours a month or whatever, and I should be able to pay $1,000 a month. And with the number that you're proposing doesn't work for us, or it's crazy, or the formula doesn't work. And then at that point, don't fall into the trap of saying, well, let me show you my formula, how I came up with it. All you have to say is, for clients like you with work like this, in our experience, this is the price that we have to charge, and we cannot make a business case for $1,000 or $1,500 a month. However, if there is a lesser service where we can strip away some elements from it that we can back into for the $1,000, would you be open to having a discussion around that? But everything we talked about, right? Reconciling the PayPal account and entering job costs and preparing reports, weekly, and having a monthly conversation and doing tax planning and payroll support, everything we talked about will have to be modified, right? And then I think as a firm, you should have a bare minimum of the type of client that you want. So if the client's maximum or whatever they can afford fits your minimum, you should always welcome a conversation about backing into that, but stripping elements of value and telling your client, you should never judge them for them wanting to pay you less, right? Because they still want to pay you, right? And you should, that in itself is a compliment, right? Like paying you anything more than zero, it's always a compliment, right? Because it's a leap of faith, it's trust, regardless of whether you think it's low or it's high. They're parting away their money and giving it to you.
And so if you're looking at this formula, what you're really doing is you're saying, okay, customer, you don't want to pay me $2,500. You want to pay me half of that. Well, my employee needs to be able to handle 20 of you at this size versus 10 of this size. So again, back to Deborah's point of you're looking at your employees, you're saying, how many jobs of this size can I do? I've got 5 employees. They're doing this many jobs. You're sort of all around the way that you're pricing this out in a way that's going to guarantee this sort of 30% growth, assuming all the other costs are there.
Right.
Yeah.
I think, again, exposing the formula a little bit might make the conversation a bit more awkward. What I would always do is pin it against the alternative. Okay, so the customer has, generally, they have 3 alternatives. One is do nothing, right? So just status quo, right? Keep whatever they're doing before. Second is hire someone like you or like your team member in-house to have them take care of it. And the third one is do the crazy thing of trying all sorts of different providers until they figure out the one that matches, right? So like the customer usually has choices. So you can go to your client and say, listen, if that doesn't work for you, Mary, the bookkeeper that's doing this type of work, I think you need somebody at least with that skill level. We have a service where we'll help you interview people. In my experience, it's going to cost you between $70,000 and $80,000 to hire somebody in-house, and you have somebody in-house, so they'll be able to do a lot more than just reconciling the books. So we can help you with that if that's the route you want to take. And they'll come back and go, wait a minute. If I can afford $2,500. How can I afford, $5,000, $6,000 or whatever by having a full-time employee? They're going to say, well, that idea is even crazier. But you go, but that is the alternative. Right? Those are the choices that you have, and that's it. So it's got to be a simple, honest conversation like that. But if you do this formula, you do come up with a number and it's whatever between $2,500 and $3,100, and you end up accepting less and doing the work that you promised to do, which again, it will take it will take 10% of the capacity. You're essentially, there's nothing wrong with that, but you're accepting a sub 30% business profit. So you're making the conscious decision as a business to make less than 30% profit. And that's what interns do, and that's what somebody that just got started do, and that's okay. So Are you in that period in your business where you're ready to accept your clients dictating how much money you can take home, right? Are you in that level right now? And if you are, fine, no problem. But if you have 10 years of experience, you should not even consider making less than 30% profit. Okay, so let's move on to anticipated responses. So now we kind of talked about how to think about the pricing, and again, we need an entirely different course on building packages and coming up with prices and options and all that stuff. It's not what today is about, but follow me on YouTube and you'll see I have tons of content on this stuff. Or come to Reframe and you'll walk out being a pricing consultant yourself. But let's talk about the anticipated responses. So after you present a price, a new price, a price increase, your customers are going to have, there's 5 categories of responses. Okay, 1 is shocked, the 2 is wanting to negotiate, 3 skeptical, 4 emotional, and 5 threatening. 5 types of responses. So what does a shocked response look like? Okay, somebody will go, wow, that's a big jump. I wasn't expecting this. And a person that's good at communicating will be vague enough to not say, I can't afford this or that's too much. They'll just say, that's a big jump. I wasn't expecting this, waiting for your reaction, right? So they're trying to get their
hint at you taking a step back and being like, okay.
Yeah.
Let me fix this. Now you got me scared. I don't want to lose you. They're trying to get to that conversation.
Correct. But this is more passive aggressive, right? Because they're not actually saying they're gonna leave or they're saying no. They're just saying, wow, that's a big jump. That's huge. That's crazy. I wasn't expecting that. That's double last year. Whatever the reaction is a natural reaction to react to the change. So the way I would reframe the reaction is a 3-step process. So 1 is acknowledge the reaction, very important, highlight the value, and reassure. So the process looks like this. I understand this feels like a significant change. The adjustment reflects the additional value we've been delivering and the improvements we're making to support your success. I would love to walk you through exactly what these changes are and how it will benefit your business. That's simple. Okay? That doesn't mean they're going to say, shut up and take my money. It doesn't mean they're going to say that. But that is the way you need to react to that, right? That's the most important thing, right? The client reaction is actually not as important as your reaction. Like your reaction is actually more important. So what does a negotiation response look like? They'll say something like, you know what? We'll stick with the old service. It's okay. I don't want the change. I don't want the price change. I'm glad underpaying you, the same way I've been underpaying you for the last 5 years. And I just want to get the same service. And I don't want change. I don't want anything different. Or can we meet somewhere in the middle? Like I used to pay 1,000, you told me 2,000. People just go straight into negotiation mode. So the way we reframe this to have the best reaction is 3 steps: stand firm, offer options, emphasize fairness. So we go. I have carefully structured the pricing to reflect the enhanced services and results we provide. If you like, we can explore different levels of service that align with your budget. This pricing assures we can continue to deliver the quality you've come to expect. Deliver, quality, expect. Ensure, deliver, quality, expect. All assertive words. Not everything is really expensive now. QuickBooks went up in price and my employees are charging more and my rent went up and they don't care about that stuff. What they want to hear is ensure, deliver, quality, expect.
You're going to get value for your money, and you're going to appreciate that I'm able to offer that at this price,
Correct.
even if it hurts a little bit.
Right. But you're appreciating the fact that I'm considering keeping working with you, because almost I do some consulting with some firms and they come to me and they say, Hector, I have this client that I've been undercharging a lot for 5 years. Let's say I've been charging $1,000 a month, but it should be $10,000 a month, whatever. And they tell me, how do I fix this? And I say, there's a probability that you can't. There's a probability you can't. The shock is so big. So what they say, well, can we do it over time? So maybe we'll just do it little by little in the next 5 years. I really don't want to lose them. It's like, well, you're going to continue to shoot yourself in the foot for the next 4 years. So I think you should just be comfortable with saying, hey, your level of expectations have vastly outgrown our capacity. And we are building capacity to be able to serve clients like you with your level of expectations, but we're not ready immediately. So I think we're going to have to just stop servicing you completely, and you shut up.
Yeah.
You let the client react. And then if the client makes some, it's starting to now sell them to you, to go, no, I really want to work with you. I want to make this work. Then you go, if you really want to make this work, we have to make a significant change. I'm going to have to move a resource here and there. I may have to dedicate more time to you. I might have to put a new employee on your, let me go back and figure out a price for you. So instead of you throwing the $10,000 change from $1,000, you told the client, I don't think this is going to work, period, right? It's just too different. You've grown, you've become too complex, and I don't have the capacity yet. That's the magic word. I don't have the capacity yet, because yet means I can fix the capacity overnight.
Right.
You just got to give me $10,000 a month to do that.
Right.
But
right.
instead of framing
right.
it like that, let the customer sell back to you that they really want to work with you, and you say, okay, let me go back to the drawing board. Let me talk to XYZ, and then you go back and go, I think I figured out a way to make this work. And then you present the same thing you were going to present, but you did it in a very passive, aggressive way, where the customer, you weren't the one telling the customer, pay me $10,000 or else. See, you took it away first. You took it off the table first, which makes the conversation much easier, because you're no longer fearing losing the client. You already accepted the fact that you lost them. So now we're in a different conversation. Now is, how can I win you back? And that's actually much easier to have than what can I do to not lose you?
Yeah, fair.
Okay, so the next one is a skeptical response. It's like, I'm not sure what I'm getting for this price increase, right? So they'll say something like that. What am I actually getting now, that I didn't get before? And in some cases, they're not getting more stuff, right? You just, there's a value mismatch. But the way to respond to this is three-step process. Be specific, use examples, and reassure. So it will look like this. Let me show you what's new. We upgraded blank tool, blank process, and added blank feature, blank service to better serve you. For instance, now we're going to use examples. For instance, the new reporting software we introduced saves hours of manual work, giving you deeper, faster insights. And then you reassure. These updates are designed to make a real impact in your business, help you make faster decisions, right? So that's how you frame the not sure what I'm getting for this price increase. The fourth one is the emotional response. And this is the one that we fear the most, because it's the one that hurts us. This is the one that we've built friendships with these people over time. We don't want to hurt them. We want their business to do well. We know they need us. Okay, by the way, they need you, but you could also be replaced. I mean, that's an interesting thing about our world, is that our clients absolutely need us. Like 911 without us is chaos, but it's chaos for a day. They can go find someone else that can do your work. So you have to kind of live with that duality. You have to live with that reality always. So that emotional response of being your loyal client for years, this is so unfair, right? So this is the process for responding to that. So 3 steps: show empathy, focus on the partnership, offer dialogue. So you say something, I truly value the relationship we built over the years and appreciate your loyalty. Second one is, this change ensures we can continue to supporting you at the highest level. And let's discuss how we can tailor the services to meet your evolving needs.
Yeah. Okay.
So the last one here is the threatening response, where the client will say something like, I don't think I continue to work with you at this price, or this is not going to work. Like immediately saying, well, at this price, we're going to leave. Okay. Or it doesn't work, or I can't afford it. Or the typical one is, we have a small business, as if that means anything. We have a small business, therefore, Hector, you should be logical. Small businesses don't pay this price, right? They throw that at you. And again, it's a tough one to navigate, but my 3-step approach to this is stay calm, highlight the opportunity, stand firm. So it will look like this. I completely understand if this change doesn't align with your current needs. I would love to discuss how we can adjust our offerings to ensure you're still getting the support you need, and then you stand firm. We've made these adjustments to sustain the quality of service we provide, which is critical to the success of both you and me. Okay, so the theme here in all these is, we're open to dialogue. We can discuss service, and if we have to change a price, we have to change the service offering. We have to adjust the service offering for them. So, Justin, it's been an hour. Do you want to have a hard stop, or you want to finish this? I got maybe another.
I think if we can go for another maybe 5-8 minutes, and there's still some time to get into the conference where you can find out lots more about this stuff. I think that's great, and this resource will be available. But let's quickly try and go through this section, and we'll keep it going.
No problem. So the next one is called the price framework, right? So PRICE, and the price framework is positioning, resources, innovation, commitment, and excellence. And this is a framework to be able to hit all the points you need to hit in a price increase email or a price increase face-to-face conversation or Zoom conversation. You're not going to say, well, I'm changing the prices because A, positioning, and R, resources, and you don't do it like that. This is just broken down. We used an acronym that's easy to remember. So positioning, resources, innovation, commitment, and excellence. So positioning is that you are now a premium service provider, or you want to continue to be a premium service provider. You want to prioritize expertise and quality. You now have ability to solve complex problems. Therefore, you are changing the positioning of your firm, which is why you have to have a price increase. R is for resources. We have to be able to invest in better tools and training for our team. We have to invest in streamlining processes to bring superior results. And generally, resources is not something you need to justify, and they're mostly not visible, but the clients should be able to feel the difference. You want clients to feel the difference with that investment in resources. The I is for innovation, right? So the accounting profession is evolving quickly. AI is coming hard. We need to be able to stay ahead, to be able to have constant innovation and keep up with the times. We also need to implement cutting-edge technologies because other firms are doing it, or other non-accounting businesses are doing it and trying to come into our territory and pretend we're accountants with their technology. And we need to equip our firm to solve problems differently. You got to solve problems differently. Innovation is about thinking. It's about being creative. It's about trying different things and thinking outside the box. You have to be able to invest in that, right? And you can't justify charging more so you can send your employees in a spiritual journey to learn how to innovate and build something new. But you have to do it. And you have to be part of it. It needs to happen. The C is for commitment. So I think that a higher pricing reinforces a higher level of commitment that you have for your clients, and also a higher level of commitment that they have for you. The client that you've charged the most you ever charged, how committed were you, at least at the beginning of the relationship, how committed were you to serving them 1,000,000%? And when your customers pay more, there's more skin in the game, they're going to be more committed to being a partner, a collaborator, rather than just sitting there passively and waiting for you to do all the work. And you want to be able to dedicate more time and attention to each client.
Right. And that's what this pricing model allows you to do. It gives you the time to spend this, to actually be committed, as opposed to just putting it on some pricing or putting some thing on a pricing chart and saying we're committed, but actually you're running around like crazy people behind the scenes.
And the 30% profit gives you breathing space for the client to ask you a weird question, and for you not to cringe at it, to go, Mr. Client, that's a really weird question. Let me give you a non-weird answer to your weird question with calm and confidence, and not with anxiety. The anxiety.
And you can tell that difference in an email back and forth when I ask a question to my accountant and they respond thoroughly versus another one that just responds like with a link to an explanation. That difference is the difference between like whether or not I can feel that rush or I can feel your commitment.
Exactly. 100%. And then the last one is excellence. So we have a commitment to excellence. So we're gonna invest in quality. That means we're not gonna skimp in anything. Like every single thing we buy, the software package, the brand of our pens, the brand of our paper, the remote the communication software, our phone system is going to be top notch, right? Because we are committed to excellence. And the idea is that we can always exceed the standards that our clients expect. And as part of excellence is a satisfaction guarantee. When you tell your clients, listen, you're going to pay X amount. Now we're doing satisfaction guarantee, which you can have two types. One is if at any point in time, for any reason, no questions asked, you say, I'm dissatisfied with my service, you immediately refund the last month, and
I like that.
Without any awkwardness, tell the client, what do you need us to do to transition you to another firm? Or what do you need us to do to not have to give you another refund the next month? Okay, so that satisfaction guarantee is a cost for you. It's a risk, right? And you need a profit to be able to take that risk, right? So here's an example of an email that hits all the points in the price framework. So, dear client, thank you for trusting our firm for your accounting needs. To continue providing exceptional service and value, we're updating our monthly bookkeeping fee from $500 to $900 effective next month. This adjustment allows us to invest in advanced tools, technology, and training to ensure more efficient processes and deeper insights tailored to your business. It also enables us to stay ahead of the industry changes, providing you with the latest strategies and cutting-edge solutions. We are committed to delivering the highest quality of standards of service and dedicating more time and attention to your needs. If you have any questions, don't hesitate to call. Now, I have a LinkedIn article which is in the slides where I give you an example of this letter, an example of a different letter, a letter that doesn't give the price, that just teases the fact that there's going to be a conversation about a price change and about increase in quality. And then in the LinkedIn article, I talk about how to prepare for that conversation. And one of the best ways to prepare for that is to create a frequently asked questions and make it public. If you go through the exercise of the top 10 questions, 10 questions that you think your customer will ask, and you pre-answer them and you put them in the website, and you make it public, or maybe you put a link to that in that email, you're basically sending a signal that this price change is a matter of policy, not preference. And the minute you say it's policy, that means it cannot change. If it's preference, it's moldable. So it's not about you wanting to make more money, it's about your firm's policy to increase the prices so you can have commitment to quality.
Yeah, and I bet doing this exercise is actually a really good way of you starting to almost write your mission statement or your sort of commitment to excellence, because it's going to force you to think through all the reasons why somebody could object to this, and that I have to answer these questions, but I actually have to go deliver this level of expectation, and now it's written down for you as well. It's like it's a forcing mechanism to make sure that you can stick to it.
It forces you to prepare. You've made a public announcement. Your bottom line, like it's a commitment to yourself, to your firm, and to the world. So you go through these questions, and again, this is 9 examples. You can come up with more or change them or modify them, but go through the exercise of having to think of an answer.
I like that.
So there's a LinkedIn article that you can go to that goes into that level of detail. And also, to make things even more fun, I took this presentation and the LinkedIn article and I put them in something called Notebook LM and published a 20-minute sort of like communication. It's just blank, but it's a 23-minute sort of AI-based podcast that talks about this presentation. So if you like this content, I want to spend some time maybe listening to how AI interpreted all the content that we're covering here and the article, you can go to that. So the LinkedIn article that I published today, actually this morning on purpose, I was doing it in preparation for this webinar, and that AI podcasts are good companions to this presentation.
Okay. Well, thank you very much for this. Thank you for all the questions. And Hector, tell us if you want to go 8 layers, 10 layers deeper on this. Talk quickly about Reframe.
Yeah, so Reframe is the organization that I started with my brother, with Carlos. And it's about rebranding the profession. That's our mission, to rebrand the profession, to be sought after as the most creative, innovative, and forward-looking. And we do this in multiple ways. One, we have a free webinar series that you can register. And for the next 10 months, we are going to explore these topics in lots of depth. And we're going to bring other people and authors of famous books about pricing and that sort of thing to have this deeper conversation with us. But this will all culminate into an event that we're going to have in Coral Gables, Florida, at the Lowe's Plaza in Coral Gables, which is a beautiful, fully renovated hotel. We're going to have an event with 150 accounting professionals, and it's called Pricing with Confidence. And it's a 2.5-day event. We're going to discuss theory, practice with each other. We're going to have roundtables. It's going to be a mastermind and a conference and thought leadership and all that stuff all in one. I host it. My brother Carlos hosts it. We have some really kick butt speakers that we're going to announce next month that we are signing contracts with. We have a room rate with the hotel for $279. We have a limit of 150 accounting professionals. We have 137 deposits, so we only have a few more tickets to sell already this early in. And the reason for that is because we had 125 people last year, and we had a 95% repeat. So 95% people say, "I want to come back to this." And last year was a completely different topic. It was influential conversations. It was all about communication.
Right.
So we raised the price this year. Last year was $1,500. Now it's $2,000, and we're gonna deliver an incredibly transformative experience for our fellow accounting professionals. So if you want to learn more about that, go to reframe2025.com. That's simple. Reframe2025.com. Get your ticket. I'll see you in Miami in November. And if there's any other questions, I can answer them too.
Okay. I think the only one I think we didn't maybe tackle was maybe just quickly from Krista, the most common pricing mistakes firms make when they're trying to increase their revenue.
Yeah. So the most common pricing mistake that I think about is justifying or pinning the price against the effort. Is saying, because this will take me 4 hours or 6 hours, then I should price it like this. That's the single most common mistake. The way you solve that is you figure out what is the outcome, what does the customer get, the results from the work that you do, and then based on what they get, you back engineer what that's worth to their business, right? So if they get peace of mind and you remove anxiety and they get more hours of sleep and they get 2 hours a day back from admin work to focus on sales, and you think about the impact that the business owner or the CFO or whomever you're taking away work from, right? Because they're hiring you to take away work that they don't want to do in-house. Because everything that we do, newsflash, can be done by another human being, can be done by a business owner, and it can be learned online. Like, accountants do not have anything special I would say like a rocket scientist, okay, maybe they have something special, or a brain surgeon have something special. But accountants, nothing that we do is special. Everything that we do can be learned in YouTube, in an IRS document, a CRA document, online. Everything we do can be solved by doing a little bit of reading or studying and learning. Now, do business owners want to waste their time with that? No. Why don't they want to do that? Because they want to focus on growing their business. What does growing their business mean? Well, it means visiting clients, selling jobs. So if you say, Mr. Business Owner, I'm going to take away 10 to 15 hours away from you. And by the way, if you spend 5 hours in a job, the equivalent to that for a non-accountant business owner is 20 to 25 hours because they don't know what the heck they're doing, right? So your effort is worth 10 times or 5 times their effort. So now you take a look at what is it worth to give the business owner 25 hours of their time back, right? Let's say that's 10% of the time that they spend growing the business. Well, you could probably grow your revenue by at least 10% because I'm taking away 10% of your wasted time with admin. So what is your $1 million business? 10% that's worth $100,000. I'm only charging you $20,000 for my services. It's a steal. Right, so that's how we need to frame it. We need to frame that what we do is a fraction of the value that we provide, or like what they can get out of what we do. And the biggest pricing mistake is focusing on your effort and not what they get out of it.
Okay, perfect. Okay, Hector, I think we tackled everything. Thank you very much for this sneak peek of this presentation. Really appreciate it. Thanks to everybody for showing up. Yeah, go to reframe2025.com. Okay. Thank you so much, Hector. Take care. Really
Thank you,
appreciate it.
everybody.
Okay, bye.